instead of having questions, because we're just a little bit behind schedule, I'd like to call the panel up. And if you've got questions on the exit strategy, this panel, I'm sure, will be able to illuminate some of the wisdom that they've learned. And there's also going to be a period for questions at the end of the workshop, assuming we get there on time. So if you've got any questions on exit strategy, please hang on to them. And as we're going, please do fill out the evaluation form. That's really important to us to help us continually improve our content and delivery. So we much appreciate that. And while the panel's sitting down, in your workbook, you also have URLs to some videos on talks on exit strategy. We're very fortunate to have three very knowledgeable panelists join us today. And an important part of building a vibrant and sustainable angel community is our sponsors. And they help fund events like this. They help make our group sustainable, and I think we owe them all a large vote of thanks, which we'll do at the end of the panel. And I would like to ask each of you to quickly introduce yourselves, just to give some perspective. And then we're going to take any questions from anybody, and our panelists are going to have the ability to either do a jump ball and answer first, or if not, I'll politely sequence through any questions you might have. But James, could you start off and just introduce yourself, please?
You bet. My name is James Black. I'm a VP with the Canadian Securities Exchange. I'm based in Vancouver, but our office is here in Toronto, our headquarters. What I'll just say about the Canadian Securities Exchange is we're one of the more recent entrants in the Canadian marketplace as an exchange. We offer a listing and trading platform for equity and all matter securities, for that matter, that can be traded both online or through a professional brokerage. But the main thrust of our business is allowing early stage companies to access capital markets. And we do that through offering a very streamlined regulatory model and a very streamlined reporting model when you are listed. So I'll just touch on that real quick. We have a very simple set of entrance requirements. When you compare that to our competitor exchange, the TMX Group and now Equitas, it allows companies to go public that otherwise wouldn't have been able to go public on those other exchanges. So that means they can access capital earlier as a public company, and they can come to market with very little dilution in their capital structure. And maybe we'll touch on that as we talk about exits. The most important part of our model, though, is that when you are listed, we don't encumber the company with an over-regulated regime. So you come to the marketplace, and we don't duplicate or act as a business advisor to your company. We don't try to come in and tell you that this is how your company should do business. We make sure you disclose, you do it timely, and it's accurate. And that takes a lot of the stress off the company so they can focus on being an operating company, hopefully grow and add value to the investors in that company. So we're trying to make sure that companies have an avenue to access public venture capital that doesn't get wasted through satisfying the bureaucracy of being public. And we feel that that's what's lending to our success now. We have over 280 listed securities on the marketplace. And we're seeing high levels of growth, 35% growth in issuers last year, and over 150 million raised through our issuers last year. So you have to take that traditional concept of what an exchange is with the big billion-dollar IPOs and throw that out the window and look at the CSE as a way to continue your ability to raise capital in the public sphere where there may not have been other avenues to attract money for your business. So that's what we do, and that's why we call ourselves the exchange for entrepreneurs.
Thank you. My name is Gary Duncan, and I'm a partner at Gowings. We're a national law firm, and we have offices across the country in all of the major economic centers. And my practice is a transactional practice, focuses on mergers and acquisitions, both for domestic and international cross-border companies in all different industries. And as part of that practice, I help companies both buy and sell, raise capital, and as part of being in this community, I am the head of our local technology law group in this for our office here in the Waterloo region. So we help a lot of the local tech companies, help the angels as well in terms of investing and buying and selling some of those companies.
I'm Steve Landau. I'm a partner in Ernst & Young's transaction tax practice. I'm based in Toronto. We have people in our practice in our 4 largest centers in Canada, in Toronto, Montreal, Calgary and Vancouver, and through those offices we support the rest of our offices across Canada. So I work very closely with the people in the KW office to work on local transactions. I lead our sell side practice for Canada, so most of the work that I do in particular is focused on advising private business owners or private business investors to plan the exit of the company and how to do that in a very tax efficient manner. We also act in many of those situations for buyers who really want to structure a transaction in a way that's advantageous to the seller as well, so it's a win-win for everybody. We can talk about sort of the types of transactions we're seeing in the course of the discussion this morning. And thanks for the opportunity to be with you this morning.
Questions for our panel, please. It's a rare opportunity to have this much wisdom at your fingertips. Just while you're thinking of questions, what I would hope in the exits execution workshop is that we could have someone with Fiona's knowledge come in and do a whole section on the legal aspects. And we often do this in our full day version of the workshop. That's a very popular part. We often have more than one section devoted just to the legal. And the tax, as Steve said, is a fascinating and bewilderingly complex area of what we're talking about here. And one of those things where you need a lot of really good advice. There's typically a whole module on tax in the exit execution. And I wonder, and maybe you can think in your worksheet evaluation forms, James has been doing some great work with the CSE now for a few years, and I'm wondering whether part of the NACO education program might be a module on how these new capital markets are factoring in to our financing and exit strategies. So if those ideas are interesting, just help us by scribbling those down in the evaluation form. But question over there.
The investor base in the CSE, is it institutional or is it accredited investors or more general public?
In us as a company or are the companies that list on the exchange?
Yeah, the listing companies, who are their investment base?
That's a great question because traditionally what you would see, I'm always based in the concept of, when we hear the word IPO, the ingrained, embedded idea that the IPO is something that you go and do, and with Goldman Sachs or Bank of America, one of the big banks, what we see, the companies that come to our exchange, most of them are actually privately invested through accredited channels. So when we see that the angels that come in, and we've seen other friends, family, and other high net worth individuals, they're usually well represented both on the pre-public financing and also post-public. So they've actually gone public, sometimes not even through an IPO, just through a non-offering prospectus, or an RTO transaction, and gone back to the well and raised money through those folks. So sometimes you'll find people that have gone in an angel round. And one thing that I noticed when I worked with the angel groups here in Ontario, because I used to work with the NECO, was where's the transparency and where are the metrics and where's the reporting? And one thing that we allow people to see as an exchange is that on a monthly basis, and obviously quarterly and annually with all the regulated reporting you have to do. So that's very valuable for the private investors. But as we're growing, we're seeing more institutional participation. We recently had an IPO of $1.6 million, so not billions, folks, millions. That was quarterbacked by Jacob Securities here in Toronto. So we see it as micro IPO financing. That's typically where the investment dealers are coming in. It's very small financings like that. So again, to answer your question, primarily private, people accessing or wanting us, the companies on the exchange, to be better reporting for their purposes in private investment. But we see the growth with more institutional investment coming as we grow our reputation.
Other questions?
I was going to ask just a question of the folks here. How many people are angels who have invested in companies, and how many people are just founders or owners of companies who currently run companies? So just wanting to get a view on the audience that we have.
Great question. Show of hands. Investors?
Yeah.
Entrepreneurs? Okay, that's good.
Basil, do you go into capital structure in this workshop at all? I know you probably do a separate one for that, but
It's separate.
Yeah.
This is just the exit strategy
That's right,
part,
okay.
and there's a whole other huge area. I agree.
yeah. So maybe all I could say is I recommend you go to the other workshop when Basil holds it, because one of the biggest impediments to successful, whether it's a liquidity event or an exit, if you call it that on the CSE, is capital structure. So, having a structure that is applicable to you going to an investment dealer and actually creating a fair transaction. So, a lot of the times people create way too much paper in their companies, or they create founders' positions that are hard to reconcile with what the public markets will look at as fair, or even the regulators. So again, I just use it as a support for Basil's other seminar to get an understanding of that, because a lot of the time, there's not much understanding of how what you do today could affect your ability to transact later. And as we all know, time is money and time is opportunity when it comes to M&A or IPO activity. And you can dramatically delay or damage a transaction just by having bad capital structure at the outset.
And I would comment a little bit to that in many transactions we see a situation where when you're doing your initial due diligence, and that's the internal due diligence in many cases, you come across documentation that's been prepared, agreements that have been prepared that have really onerous clauses in them, or documents that very complicated capital structures. And for many buyers, one of the requirements is prior to that is that you fix that capital structure or you simplify. And in many cases, we see that some of the investment bankers come in and say, well, I've looked at everything, and before I'm going to go out there, with the SIM, I need to know that you guys are going to clean up this. I need you to clear out those, whatever it is, to simplify your structure so it's easier to market. From a legal perspective, I understand for many companies, obviously, that cash is important, but one of the things I find is they spend double or more on whether it's accounting services, legal services, when they wait to the end, and it delays your potential exit, it delays your ability to work with the buyer because you spend a significant amount of time trying to clean up structure issues, documentation issues, and things like that. And one of the things that to one of Basil's earlier points, one of the things I always advise my clients is that when you look at your exit strategy and when you look at the timeline in which you want to exit, don't wait until if you say, hey, we're looking, in 2017, that's when we're looking to exit. Don't wait until, Jan 1, 2017 to decide to look at your company, look at not just the financial side, look at your documentation and see what you have. Do it early on, and if you do it early, you have an opportunity in many cases to make changes, clean things up, so that if you're looking to sell in 2017, you're more than ready by the time you get to 2017. And so, to Basil's point, when he says have an exit strategy, and the comment about raising it at every board meeting or raising it frequently is an important one, because it keeps your eye on the ball and makes sure that you can hit that timeline and that your company is clean at that time.
Steve, I know you've got some. Please, jump in there.
Actually, from a tax perspective, certainly as I listened to Basil's presentation before about every company should have an exit strategy, that is true from a tax perspective as well. That if you set up an optimal structure to be able to facilitate some creative tax planning on the exit, that you do that well in advance, you can certainly create more opportunities to reduce the effective tax rate on a transaction, maximize the after-tax proceeds on the sale. And to most business owners or investors, that's really what's important, is what their after-tax proceeds are, not necessarily what their pre-tax proceeds are from a transaction, and especially in the entrepreneurial community. So if you sort of plan that ahead of time, make sure that the structure is set up to accommodate the right planning at the right time, that can not only streamline the process, provide you with more opportunities to enhance the tax result, but also attract investors because you have this optimal tax structure as well.
Any there? That got I had no doubt that was going to generate some questions. James.
If you spend 10 years building a company to $10 million, what's the two or three simple decision factors on whether one tries to sell it, through M&A, or whether you go public? Are there two or three key boxes you check to sort of take you one direction versus the other?
That's a good question, because me even trying to sell an exchange as a platform is not to go to every company and say, fit the square peg through the round hole. Some companies have better prospects through an M&A versus going public. I would just say for our exchange, we don't offer the scalable financing that's going to take your company through the VC track, okay? So like, I think if you've got a fairly modest growth trajectory and you say, I need to raise $2 million now, maybe $2 million in 6 months, if we hit these milestones and so on and so forth, then that's the right path for you to go. If you're going to go and say, well, this business only captures market share if we put $10 million in, or we get acquired by someone who we're going to compete against and we're going to be that pain in the butt to them that they're just going to have to buy us, then maybe that's where I take that perspective that you look through that road. So I say if you, I'm kind of debunking a few things, but I'm saying if you want to grow a little slower, almost kind of bootstrap, it's not really an exit for us, it's more of a liquidity provision for earlier stage shareholders. They get an exit, and then that company can continue to grow with a new class of shareholders and maybe some new expertise, and that's where I would push people to the CIC. So perhaps you have more comment on the M&A side. But.
I'm going to echo exactly what you said. There's no kind of magic to say, hey, you're going to IPO, hey, you're going to sell by private, by way of a private deal. When you look at kind of the landscape, the majority of companies, especially kind of now, are selling by some sort of private transaction. We're not seeing as many, as everyone knows, we're not seeing as many IPOs as we may have seen in the past. And so, the majority of times I say to them, we have clients come in, and almost every day, so many of them are saying, hey, I'm looking to IPO. So their exit strategy is they think they're going to IPO. And I think it's because that's part of the buzz, and people think that means success. Whereas in many cases, when you're looking, we say to folks, get ready and get all the things we've talked about before now. Get all those things ready, get your ducks in a row, but really think about what an IPO means. Are you scalable, and all those different type of things that the folks up here have been talking about. There's no one right answer, no one shoe fits everyone, but the majority of companies that are exiting, I would say, are exiting through private sale.
So one of the things that sort of comes to mind is that exit means a different thing to different people. So does exit mean I'm retiring and I wanted to no longer be involved in the business? Does exit mean I want to diversify my family wealth by trying to monetize some of the value of my business that's sort of a disproportionate portion of my the wealth of my family to de-risk your family wealth situation? And it can mean different things to different people. And of course, the result of how you plan that is very different as well, both from a business perspective, but also a tax perspective. And so one of the things that we see most often with entrepreneurs is that they do a great job of building a company that's very valuable and has great opportunities. But too much of the goodwill related to the business is personal goodwill. It's not necessarily that portable in terms of selling it. And to who is a likely buyer? It could be a strategic, which doesn't care as much about personal goodwill. But often the exit is to some type of financial buyer, like a private equity fund, and they don't run companies. They bring in professional management, or they have the existing ownership team, or the founders stay on in some capacity and having some skin in the game still, but having some rolled equity interest in the business. And so, that's not really retiring. That's just sort of having a partner in the business, but you've been able to diversify your family wealth by taking out some cash in the process of that transaction. So you have to really think about what the exit objective really is.
And to go to your point, sometimes when that's a private equity buyer and they want the founder to be continually to be involved in the business, that's also in many cases problematic. For the founder, you have someone or an entrepreneur who's been running its own business for however many years and calling the shots, and so all of a sudden now there's this probably level of administration or additional approval levels that they need because they have a different buyer, and so as well you have to look at who you are, whether you're willing to work for someone else. Do you want a full exit? Do you want to retire? Do you want to work part-time and know that you're no longer the person calling the shots? So all of those things, to go to your point, all of those things are part of the planning and deciding what type of exit works for the company, whether the founder entrepreneur is key to that business, or whether the founder is not key, will depend in many cases on who your buyer may or may not be.
There's another question over here.
Yes, I was going to ask Fiona, you were talking about having to fix up some things in the structure of the companies. I wonder what are maybe a couple of the most common things that you would find companies have made those mistakes and they need to be fixed up at exit time?
So in many cases, one of the, it's pure kind of capital or share structure. For example, I had a company, I think it was last year, come in, and they had probably 10 classes of shares, all with different attributes, very complicated articles. They just continually amended by adding in additional classes, not consolidating in one kind of consolidated set of articles, so everyone knows what the rankings are of all the different classes of shares. It got pretty complicated because there were different, liquidation rights, anti-dilution rights associated with all the different classes of shares that are there. And when you looked at the cap table, it was, at first it was a beast, but then on top of that, it was very complicated to figure out on an exit what each party got. And so that would kind of be my first one, is just companies sometimes think that they have to issue one class of share to each investor, different, it may all be a Class A common share, Class B common share. It's not like all of the shares had different attributes, but it just made it complicated. Another issue that we see more often, and more often lately with some of the deals that are coming to us, is consulting agreements with a variety of different individuals with equity rights in them. And again, those equity rights aren't, it's not necessarily a stock option. It could be restricted stock. It could be part cash, part stock. And they have an impact on your cap table, but in many cases, the way they were drafted, there's no ability to figure out, unless it's at a specific point in time, exactly how many shares or options that they might get. And that makes your cap table very complicated. Options granted outside of and with no connection to a stock option plan as well is another one that we see a lot that needs cleaning up. And then a general comment to your question would be terms and agreements. So terms in your commercial agreements for a company. We're seeing, non-competition clauses, non-solicitation clauses, and not that those are uncommon in some of those arrangements, but in many cases, the company wasn't aware that those clauses even existed in those contracts. In some areas, it prohibited the company from an entire jurisdiction, and in many cases, they had a growth strategy to say, hey, this is where we want to take the company, we're going to go into all of these different jurisdictions, but then they had agreements that they'd signed with other parties that prohibited them from doing so, and they weren't aware of that. So those are some of the things that on a exit, these are things that your buyer is going to look at and decide how that kind of balances against where they're looking to take the company. I hope that answers your question.
Yeah, sweat equity is obviously the big challenge. You got to early on in your company. We see this all the time. They come to us and go, well, and the auditor obviously has to deal with this, is what is the value of the time I put into this business? And you have to find fairly early on as a company how you're going to account for that, because it can create some real disharmony later on when the founder thinks that they put in $3 million worth of value of time, and that's not reflected in the eventual valuation of whatever they get out of the company. So, which leads me to the other point, which is valuation. And frankly, if you're going to have an exit plan, you better know what you're worth now, and then what you want to be worth later on, or else you're going to have, again, some unmet expectations. And the worst thing you can do, and I'm sure Basil teaches this in his other shops, is don't overvalue your company, or else you're going to end up with some funky accounting later on. So those are just two of the main things that we come across when we get people who are ready to go public, and then you go, whoa, take a step back here and understand there's some revisionist history that has to occur before this thing is going to go elsewhere.
And Richard, just one more comment to add to that. It's your shareholders agreement. That's the other one that I always say to people, if you're thinking about exit or looking to exit, take a look at your shareholders agreement, make sure that it works, make sure you have the ability, for example, to drag minority shareholders if you need to drag minority shareholders. I'm right now working on a deal where there are minority shareholders. There's no drag-along provision in the shareholders agreement. It's a company that came to us to help do a deal. There is no drag-along, and they have some minority shareholders who just aren't willing to sell. Partly because of the valuation that's there, and they're not going to get a lot of money to put in their pocket. But if that, prior to that point, if that was something, and really from day one, to make sure that you have those provisions so that you don't have a deal where you have, a shareholder holding, under 5% that has the ability to block the transaction.
Steve, I'd be curious to know if you have an opinion on options as part of capital structure. And I had a nightmare of an experience a little while ago where we were selling a company that had a significant amount of option value on the cap table. And, I've been watching the government keep trying to change the rules, hopefully making options work better. What I didn't fully appreciate was that, and we were selling the shares of this company, the last changes the CRA made created an obligation on the part of the company to withhold on a transaction the amount for the gains to the individuals. And another obligation was that if the options hadn't been granted at fair market value, that was a liability for the company. And so we were doing a cross-border transaction. The Americans had never seen this before. The deal almost died because we couldn't quantify the potential tax liability. If those options hadn't been granted at fair market value, the amount of tax that needed to be withheld was enormously more. So the buyer's council said, no problem, we'll just escrow that. And then they said, until the statutory limitation, which is like 7 years. And the sellers were like, we're not doing that. And the thing, we went back and forth. It was a complete nightmare. Any similar experiences or any way to avoid those pitfalls?
Well, just a couple of things to clarify how the tax rules work in those circumstances. So if you're dealing with a Canadian-controlled private corporation or CCPC, there are sort of one whole set of rules dealing with options that are relevant and dealing with employee share ownership. So the general rule is that you want to try to put the employees who are holding options in a situation where they're getting capital gains type treatment from the value of their options. So that might be either a cash settling of those options as part of the transaction, or it might be an exchange of those options for shares of the company that are sold to the buyer, or roll of those options, those shares for buyer shares. Or exchange of the options for buyer options, and there's all kinds of different ways you can do it. But if you don't meet certain conditions, the gain inherent in those options can give rise to a fully taxable option benefit rather than the more favorable capital gains rate, or really half the effective rate. And the rule is that if you're just holding an option, you're not holding a share. The rules are quite simple, that if the option was not granted at a strike price, which is either at or in excess of the fair market value of the share at the time the option was granted, then you can't meet the conditions for the more favorable tax treatment. So if you sort of give sweat equity options where they pay a nominal amount for those options, then you're always going to be in a situation, unless you exercise the option, that you're going to have a fully taxable employment gain. That's going to be T4'd and withheld and so forth. If the option is not in the money at the time it's granted, then you should be in a position where you get the more favorable treatment. For a CCPC, if you actually don't have, if the option's exercised or you issue a share, a couple of benefits to that. One is that the share, if you hold that share for 2 years, you get, regardless of whether or not the option was issued in the money or not, you get the more favorable tax treatment on the option benefit. But secondly, the increase in value from the time you exercise the option and hold the share to the time you actually sell it is eligible for the capital gains exemption if the shares otherwise would qualify. So that's not just capital gains rate, that's zero tax effectively, to the extent of the capital gains exemption is available. So a little confusing to sort of talk about it in a generic context like that, but there are some tricky things that you got to make sure you take care of in that process. And again, in the readiness of an exit, maybe you got to plan those things so that people have the opportunity to hold the shares for 2 years or before an exit as well. They get the more favorable tax treatment.
Let me just add a little bit to what Steve said. This is where we got messed up, was this fair market value point. Because as you said, if it wasn't fair market value, then you're in a really very bad situation. The solution that I was recommended by the lawyer who was trying to help us was that it's actually pretty simple to just put that in the board minutes. And this is not a guaranteed fix, but there is some evidence that the CRA will take the opinion of the board at the time and weigh that pretty heavily. You know, the challenge that we had was that this was like 3 years before. So you're trying to figure out what the fair market value was 3 years in the history of a startup. You know, how do you do that? And it's exiting at some pretty big values. We know what the exit value is. Trying to work back was a really big problem. And for some perspective, our friends to the south have a new requirement where if you're granting options in a company, you have to value the company every quarter. It's called the 409A. Big boon to company evaluators, but that's how far the IRS has gone to try and keep this working, is they require a formal process every quarter. A complete nightmare.
And to that point, we do see that probably every day when you have I got an email just this morning actually, someone saying I want to grant options and I want to grant them a nominal amount. But they're recently selling shares to investors at $6 a share or whatever it might be, and so that is I would say for so many companies, they're not going to get a valuation every time they go to issue an option or issue a share, and that the directors that is something the directors make a determination of what they believe, as you indicated, the fair market value is when they issue shares. And that's currently a challenge in a startup company where they don't have the funds to have a valuator do that, whether on a quarterly or even on an annual basis. So the comment that you said from your counsel about putting it in, having the directors put it in the resolution, that's helpful for sure, because it's the directors who have decided that that's the fair market value, because they're the ones who have to issue the option or the share. And it's valuable to for both directors and the company and investors, because the directors are the ones who have made that decision, and at least now you have that decision on paper. I know there is a train of thought as well for folks to say, we don't want it on paper at all. We don't want evidence of it. The directors don't want to be thought to be on the hook for that valuation. However, it is the directors who are ultimately issuing the shares and have an obligation to issue the shares for fair market value or above.
Certainly from a tax perspective, CRA has the habit of using hindsight when they try to value a company. What do you mean it was only worth X dollars a year ago and you're selling it for Y dollars a year later? And they don't understand sometimes that there are sort of significant events in the history of a company that dramatically change the value within a relatively short period of time. So it can be a difficult thing to determine what the appropriate treatment of the options is. Again, advanced planning is always better than not.
I agree. Don't do this alone. You need help if you're going to grant options. I think we have time for 2 more questions. Anybody want to take it a different way or ask another thing about options? Kevin?
You used the term Basil earlier. You talked about when you prove the business model, it's the best time to sell. And then you kind of talked a little bit about companies getting into that middle age, kind of that category, which I'm just wondering is the value of the company, do you find in your experience for all the panelists, is it better to kind of sell it in an earlier phase, or would you get the same value at a later stage in your experience, or do you have a sense of that? Or
let's hear what the panel thinks, and then writing it over the top is actually the next module. So I'm definitely going to cover some of that. Anybody want to touch that grenade?
We see companies ride over the top all the time.
Okay.
Yeah, and then they end up blowing up and then becoming shells or whatever, and they try to bring in a new business and get the excitement level back. But we feel that, again, to go back to the point about what does an exchange do, it doesn't necessarily have to be the Shangri-La of exits. It doesn't have to be the time and place where everyone rides off with a new Ferrari after the transaction. we see where you can actually come and continue to raise and still work through that growth phase, even pre-revenue, believe it or not, on a public exchange, so that you can eventually reach that point. And we've had a few companies that are doing a nice job reaching that stage. We have one called Resas that's been public for a few years now. They did a small IPO, 25 cents. Now their stock is over $2. This is say around 130 million market cap. And they used options as a public company to attract staff, so that was another benefit of them having a fair market value. So we see that those companies are actually using the platform to get to that stage, and you know, it doesn't happen with all of them, but it does happen, and you know, that's just one example that comes to mind.
Sorry, maybe just to follow it up.
Yeah.
Are there any signs you might see where you say this company should go now?
I mean, dilutive financings, highly dilutive. When we get the calls and they say, you know, our market's trading at below 5 cents and we need an exemption to raise money, that's panic territory. And, you know, nobody's exiting then. But that's usually companies are on life support at that point, and they may be ripe for the picking for a new deal or some rollback. But, yeah, that's danger territory for sure.
I mean, I would say there's no, there's no hard cost answer on when the right time is to exit. It depends on the company. It depends on your objectives. You know, what I've seen a lot of, which is interesting, is we've seen partial exits. So they take, you know, a PE firm comes in, they take a significant amount of money off the table, the founders, you know, enough that some people would view that as a full exit. and then they stick with the company, and then, you know, 5 years down the road, 3 to 5 years down the road, the PE firm sells, and they basically took a, you know, what I would consider a double exit. It gave them the ability to be flexible, to continue to work for those who wanted to do that, to continue to have some money, skin in the game, and some control. And it is something where we tend to be seeing a lot more of these days, and you know, they get a double dip, and it's, you know, for the ones we've done, it's been really advantageous.
We certainly see situations where the founders on the second exit are, even though they're selling a much smaller percentage of the company than they did in the first exit, is that they're actually getting more in proceeds in the second exit on the first exit. And certainly when we set up a tax structure for them and how they're going to hold that rolled equity interest, we try to create an opportunity so they can optimize what the tax result is on the second exit as well.
Yeah, the pie gets bigger, and that's our philosophy too, is that if you can go and use our platform, and then, you know, say that company I mentioned were to look at NASDAQ, and then, you know, say they hit their revenue, hit revenues, period, and actually started monetizing their audience that they have, that to us would be a phenomenal success. We'd love to see companies use us and then go to NASDAQ, and then maybe they can drive off the Ferraris. But you know that through that period, some of their seed financiers and some of the owners have at least had an ability to liquidate some of their position to, as you say, de-risk what they put in over the past 5 or 6 years.
I think we have time for one more question. Last opportunity for the panel. Sure.
A few years ago, Kevin O'Leary addressed a group of people in this building. Question came up in the question and answer period. When is it the best time to sell one's company? Mr. O'Leary answered quite simply, when someone, and hopefully 2 or 3, want to buy it.
Absolutely. That's an excellent lead-in to the final module in today's workshop. Thank you, Mr. Bingaman. And so what we're going to do now is we're going to first of all thank our panel, and we're going to have a short break. So join me in thanking the panel today, both for their participation and their sponsorship. And then let's take a 5-minute bio break. And let's come back, and we'll have the last module, and then we'll have some more questions.